Real estate investors frequently hear a simple piece of advice: using borrowed money is the fastest way to build wealth. The traditional approach relies on paying cash outright for a single property. The leverage strategy uses financing to stretch that same amount of capital across a much larger property, or a portfolio of multiple acquisitions. That strategy is financial leverage. It means using borrowed capital to control a real estate asset. The primary metric for measuring how much of that property is financed versus owned outright is the loan-to-value ratio, or LTV. A smaller down payment produces a higher LTV, and a higher LTV inherently means the investor is utilizing more leverage. The underlying truth here is that debt is neither inherently good nor bad. It is a mathematical amplifier that changes the size, the timing, and the risk of an investment's returns. This chart shows amplification. Here are two identical $300,000 properties. On the left, all cash. On the right, $75,000 down, $225,000 financed. Suppose the property appreciates 5% to $315,000. For the leveraged investor, that $15,000 is a 20% gain on their down payment. That mathematical multiplier does not care which direction the market is moving. It applies exactly the same way in reverse during a contraction. If the property declines by 5%, the resulting $15,000 reduction wipes out 20% of the investor's original cash investment. And this simplified baseline model completely excludes closing costs, financing expenses, local property taxes, and unexpected repairs, all of which make the actual out-of-pocket losses steeper. Leverage exposes the investor to the price movements of the entire asset, not merely the fraction of cash they initially invested. Professional investors recognize three distinct states of leverage. The first is positive leverage. This occurs when the return generated by the property is strictly greater than the effective cost of the borrowed money. The second state is neutral leverage. Here, the property's return roughly equals the cost of the debt. It helps the investor preserve cash for other uses, but it does not meaningfully improve the property's immediate return on equity. The third state is negative leverage. This happens when the cost of financing outright exceeds the operational return produced by the property. Operating in negative leverage is not an automatic failure. An investor might accept it temporarily if they project future rent growth or plan specific value-add improvements to the building. But the danger of this strategy is severe. Until the property's performance improves, the investor must continuously inject their own personal liquidity to support the loan and keep up with operating expenses. Surviving negative leverage requires massive cash reserves, a highly realistic improvement plan, and a definitive timeline for turning the cash flow positive. Relying entirely on projected future appreciation to fix negative cash flow today makes the acquisition a speculative gamble rather than a stable investment. A common misconception among newer investors is assuming a property has positive leverage simply because its capitalization rate is higher than the mortgage interest rate. Let's look at the $24,000 in net operating income. The unleveraged cap rate calculates to 8%. Now, assume the investor secures a $225,000 mortgage at a 6.5% fixed interest rate, amortized over 30 years. Comparing that 8% cap rate to the 6.5% interest rate is a dangerous shortcut. The mortgage rate only measures the interest charged by the lender. It completely ignores required principal repayment, and professionals use the mortgage constant. This metric measures annual principal and interest payments divided by the original loan amount. Because it includes mandatory principal reduction, the mortgage constant on an amortizing loan will always be higher than the stated interest rate. Principal repayment builds the owner's equity, so it isn't an economic loss, but it remains a strict monthly cash flow obligation that drains the bank account.
True institutional analysis requires comparing the property's unleveraged return directly against the mortgage constant, not just the quoted interest rate. On the dashboard, the annual principal and interest on that $225,000 loan equals roughly $17,066. Subtracting debt service from our $24,000 NOI leaves $6,934 in pre-tax cash flow. Dividing that $6,934 by the $75,000 initial down payment reveals a cash-on-cash return of 9.25%. Next, we calculate the debt service coverage ratio, or DSCR. Dividing the $24,000 NOI by the $17,066 debt service lands at 1.41. This means the property produces $1.41 in operating income for every dollar of debt service, creating a 41-cent cushion. Investors assume a 1.25 DSCR is a universal law, but it's a lender minimum that scales with the property's income volatility. Finally, we measure debt yield. Dividing the $24,000 NOI by the $225,000 loan gives us 10.67%. Debt yield isolates the property's income relative to the total lender exposure. By removing the interest rate and amortization schedule from the equation entirely, it provides a raw measure of the asset's earning power. Together, these three metrics, cash-on-cash return, DSCR, and debt yield, create a three-dimensional view of risk, proving whether a property can actually sustain its leverage. Real estate models built exclusively for ideal conditions are highly fragile. Professional underwriting demands stress testing against structural realities. Let's apply a stress scenario. Suppose vacancy rises, rent declines, and expenses increase 10%. Our net operating income drops to $21,180. Recalculating the safety margin, dividing the new NOI by our fixed $17,066 debt service drops the DSCR to 1.24. At 1.24, the property still produces enough income to pay the mortgage, but the financial cushion has evaporated. With a compressed ratio, a single major repair or prolonged vacancy requires the owner to inject personal capital just to prevent default. A responsible leverage analysis must calculate exactly how much operational failure a property can endure before it crosses the line into negative leverage. Standardized models often collapse when they hit location-specific realities. The Texas market perfectly illustrates how localized policies change the math. The most common failure point is the property tax trap. Investors frequently underwrite a purchase using the seller's current tax bill, failing to realize that the state's residence homestead exemption will be removed after the sale. When local taxing units reassess the property based on its new acquisition value and its status as an investment, the owner is hit with an immediate and massive spike in operating expenses. Then there is environmental risk. Most standard Texas home insurance policies explicitly exclude flood coverage. Relying strictly on MAP SEMA high-risk zones is dangerous. Properties with complex drainage patterns or those located near local bayous often require expensive, specialized coverage regardless of their official zone designation. On top of insurance, unmapped local assessments like municipal utility district taxes and public improvement district fees can silently drain cash flow if they aren't explicitly accounted for during the underwriting phase. A property with highly attractive baseline numbers can instantly become a toxic leveraged asset once local tax reassessments and realistic environmental insurance premiums are accurately factored in. The ultimate rule of institutional real estate investing is this: leverage does not and cannot make a weak property a strong investment. Debt creates a rigid payment obligation under all conditions. The most resilient leveraged portfolios are defined by highly defensible income, adequate debt coverage, and massive liquidity reserves to absorb the unexpected. The investor's goal is never to borrow the absolute maximum amount available. The goal is to carefully utilize the precise amount of debt the asset can safely support through a downturn.